Market myths debunked. The truth about buying the dip. Imagine watching your portfolio shrink after continuously buying the dip, thinking you're getting a bargain. You've seen the headlines flashing across your screen. Dip buyers rush in. The endless TikToks that say just buy the dip. It always works. Quick montage of bullish headlines and TikTok clips flashes across the screen. But is it really that simple? Since the start of 2008, the S&P 500 has seen 9 corrections, peak to trough declines greater than -10%, about one every 1.5 years. Blindly buying the dip before a clear market reversal would have led to significant losses, and the average correction sees the market drop by -14.3%, which can be painful. However, sometimes you can find great deals, especially when fundamentally strong companies experience temporary dips due to market-wide panic or short-term news. We need to separate healthy companies from the ones that are doomed. What exactly is the buy the dip myth? Buying the dip simply means purchasing more shares of a stock or ETF after it has experienced a short-term price decline, assuming it will quickly rebound to its previous highs. You've probably seen the endless TikToks saying, just buy the dip. It always works. Or the swarms of retail investors flooding into a stock because it is on sale. This seemingly simple strategy is often promoted without any context as to the health of the underlying investment. Where does this idea come from? You'll often see this advice on platforms like Reddit's r/Wall Street Bets, where users share screenshots of their YOLO bets, or on Discords that are catered to specific stocks. Show brief screenshot of a hyped up r/Wall Street Bets thread, blurring usernames. Also, certain self-proclaimed gurus on YouTube and Twitter push the narrative without mentioning risks. Even some financial news segments, with their limited time, can unintentionally oversimplify the idea. Why do people fall for it? So, what's the psychology here? It taps into our desire for a quick buck, making us feel like we're getting a steal. Plus, we tend to assume the market will keep doing what it's been doing recently. That's called recency bias. And, even more powerfully, there's loss aversion, the fear of missing out on a potential rebound, FOMO. Coupled with the pain of seeing their portfolio shrink, drives people to buy the dip even when it's not a good idea. But, buying the dip is a smart idea when strong companies are at their low value. It sounds good, but is it really that simple? Is it true that you can just blindly buy the dip and win? We will show you when it works, when it doesn't, and what smart investors do instead. Section 2. Beyond the bargain. A balanced approach to buying the dip. The siren song of buying the dip can be dangerously alluring. It whispers promises of quick profits and discounted assets, tempting investors to dive in headfirst, without properly assessing the risks. While the potential rewards can be enticing, blindly following this strategy can lead to significant losses if you ignore the crucial signs that a stock is in trouble. At its core, the temptation to buy the dip often stems from a dangerous combination of cognitive biases, most notably anchoring bias. Fixated on a stock's past high price, investors perceive any subsequent drop as a temporary blip, an opportunity to buy low before the inevitable rebound. However, this fixation can prevent them from objectively evaluating the company's current health and long-term prospects. To avoid this trap, investors must move beyond the superficial allure of a discounted price and carefully analyze the underlying fundamentals. It's not just about the price, but why the price has fallen. Is it a temporary setback? Or is it a symptom of deeper, more systemic problems? Here are the key factors to consider before buying the dip. Declining fundamentals. Is the company's core business struggling? Declining revenues, eroding profit margins, and weakening market share are all red flags. Excessive debt. Is the company overleveraged? A high debt-to-equity ratio can indicate financial vulnerability, especially in a volatile economic climate. Competitive pressures. Are new entrants or disruptive technologies eroding the company's competitive advantage? Is the industry landscape shifting in a way that disadvantages the company? Poor management. Is there a crisis of leadership or strategic direction? A lack of vision or a history of poor decisions can significantly impact a company's long-term performance. Bad news and red flags. Are there any legal troubles, regulatory changes, or scandals that could negatively affect the company's earnings or reputation? These factors must be evaluated within the broader economic context. A seemingly attractive dip during a booming economy might become a disastrous investment during a recession or market correction. A Fed rate cut can temporarily boost market sentiment, but it won't solve fundamental problems, like declining earnings or excessive debt. The Lehman Brothers collapse, 2008. A lesson in due diligence. The 2008 collapse of Lehman Brothers serves as a stark reminder of the importance of due diligence. While many investors saw the falling stock price as a buying opportunity, the company's underlying financial problems were ignored. Understanding the issues could have saved investors a great deal of money. Spotting a potential bargain. While blindly buying the dip is dangerous, there are situations where it can be a successful strategy. When a fundamentally strong company experiences a temporary setback due to market-wide panic, short-term news, or an overreaction to minor earnings miss, a buy-the-dip strategy can potentially yield attractive returns. Better investment strategies. Focus on strong fundamentals. Look for companies with consistent earnings growth, a healthy balance sheet, a competitive advantage, and a competent management team. Consider valuation metrics. Use tools like the PE ratio, price to earnings, price/book ratio, and discounted cash flow analysis to assess whether a stock is undervalued relative to its intrinsic value. A low PE ratio, for example, might indicate that a stock is undervalued, but it's important to consider other factors as well. Conduct thorough due diligence. Analyze financial statements, read industry reports, and evaluate the competitive landscape. Don't rely solely on headlines or social media chatter. Addressing the time in the market argument. Some argue that time in the market is more important than timing the market, suggesting that investors should simply buy and hold regardless of market conditions. While a long-term perspective is generally beneficial, ignoring fundamental problems and blindly buying the dip can lead to devastating losses, negating the benefits of a long-term investment horizon. User Sarah123 from a popular investment forum shares a story on the importance of doing research and analyzing instead of buying the dip. In conclusion, buying the dip is not a foolproof strategy. It requires a balanced approach, careful analysis, and a willingness to acknowledge the warning signs. Instead of blindly chasing the next bargain, focus on identifying fundamentally strong companies that are poised for long-term growth. That should guarantee a good investment opportunity, based on economic status and overall wealth. Section 3. Real-world lessons. When buying the dip turns into a costly mistake. While understanding investor biases and financial metrics is crucial, the true weight of blindly buying the dip is best grasped through real-world examples. These are stories of everyday individuals, and even some sophisticated investors, who learned firsthand the price of neglecting thorough research. To protect privacy, names, stock symbols, and specific financial figures have been generalized or altered. The purpose is to illustrate the types of mistakes made, not to identify specific individuals or investments. It's important to acknowledge that not every attempt to buy the dip ends in failure. Indeed, a well-researched entry point into a fundamentally sound company during a temporary downturn can prove highly profitable. However, the following examples serve as cautionary tales of what can happen when caution is thrown to the wind. Case Study 1. Tech hype turns to dust. Mark, a 30-something engineer, saw Tech Co., a flashy tech startup, dip after a disappointing earnings report. He remembers feeling like it was a can't-miss situation. Encouraged by online forums and friends, he ignored increasing competition in the sector and Tech Co.'s worrying cash burn. Mark continued to buy the dip, convinced a turnaround was imminent. Unfortunately, the turnaround never came. The stock plummeted, ultimately leading to bankruptcy. Mark estimates he lost about 20% of his overall portfolio, a sum totaling approximately $15,000. Lesson learned: FOMO, fear of missing out, can cloud judgment. As financial analyst Jane Doe notes, it's essential to detach yourself from the hype and focus on objective metrics. Emotion-driven decisions rarely lead to positive long-term outcomes. Case Study 2. The commodity roller coaster ride. Maria, a retired teacher, sought stability in Energy Gold, a company involved in energy and precious metals. Influenced by a popular investment guru, she disregarded the company's high debt levels and sensitivity to fluctuating commodity prices. When Energy Gold dipped, Maria treated it as a secure opportunity, reasoning that energy and gold are always in demand. However, Energy Gold was overleveraged and struggled against larger competitors. As commodity prices continued to fall, the stock followed, costing Maria roughly 30% of her retirement savings, or close to $22,000. Lesson learned: diversification is key, but it's not enough, explains financial advisor John Smith. You need to understand what you're diversifying into. A portfolio of fundamentally weak companies, even across different sectors, is still a risky portfolio. Case Study 3. A biotech's broken promises. David, a healthcare professional, was drawn to Pharma Hope, a biotech firm with a promising drug. He saw the dip following a regulatory setback as a temporary hurdle. He was convinced that because the science was sound, the drugs would eventually get approved. However, David overestimated his knowledge of regulatory pathways. Pharma Hope continued to deal with delays, eventually failing to achieve approval. David was overly confident in his knowledge of this industry. Pharma Hope shares would never grow again. It's not enough to say I know what I'm doing. You actually need to be able to understand the full complexity and the risks, says financial analyst Paul Walker. Don't be foolish. A major hedge fund's gamble. While often attributed to individual investors, even seasoned hedge funds have fallen into the buying the dip trap. In the late 1990s, Long-Term Capital Management, a hedge fund led by Nobel laureates, employed sophisticated models and trading strategies. However, a fundamental flaw in their assumptions led to significant losses when the Russian financial crisis unfolded. The fund attempted to buy the dip on positions that were based on unsustainable assumptions, resulting in an almost complete collapse that was prevented by government intervention. Key takeaways for all investors. As these stories illustrate, successful investing goes far beyond simply buying low. It demands a rigorous assessment of a company's fundamentals, an understanding of the broader economic context, and a willingness to challenge your own biases. Before even considering to buy the dip, it is crucial to review the company, management, and industry as a whole. Before you buy, ask yourself, is management competent and ethical? Does the product have value? Is the company doing good in the community? Actionable steps. Conduct thorough due diligence, analyze financial statements, read industry reports, and evaluate the competitive landscape. Seek professional advice. Consider consulting a financial advisor who can provide objective guidance and help you develop a sound investment strategy. Diversify your portfolio. Don't put all your eggs in one basket. Diversify your investments across different asset classes and sectors to mitigate risk. This story is to emphasize taking the safe and correct approach when it comes to investing to secure future value and overall wealth. Section 4. Building a resilient portfolio. Turning investment principles into a personalized plan. Having explored the potential pitfalls of chasing quick gains, it's time to shift our focus to building a robust and personalized investment strategy designed for long-term success. This isn't about finding the holy grail of investing, but about creating a strategic framework that aligns with your financial goals, risk tolerance, and understanding of the market. Moving beyond generic advice, a deeper dive. While principles like fundamental analysis, value investing, and dollar cost averaging are foundational, they require a deeper understanding and more specific application to be truly effective. 1. Mastering fundamental analysis. Unveiling a company's true worth. Key ratios and what they tell you. P/E ratio, price to earnings. A low P/E may indicate undervaluation, but compare it to industry peers and consider growth prospects. A high P/E can signify overvaluation or high growth expectations. Debt to equity ratio. A high ratio signals risk, but also assess how the debt is being used. For example, expansion versus covering losses. Ratios above 2.0 generally require extra scrutiny. Return on equity, ROE. A high ROE indicates efficient use of shareholder equity, but ensure it's not artificially inflated by excessive debt. A good ROE depends on the industry, but generally 15% or higher is considered strong. Revenue growth. Consistent year-over-year growth is a positive sign, but analyze where that growth is coming from. For example, organic growth versus acquisitions. Actionable tip. Don't just look at individual ratios in isolation. Analyze trends over time and compare them to industry averages. Use a financial statement analysis template, easily found online, to streamline your research. 2. Value investing. Finding opportunities beyond a low P/E. More than just a low ratio. While a low P/E is a starting point, dig deeper. Is the low P/E due to temporary headwinds? Or is it a sign of long-term decline? Look for a moat. Focus on companies with a sustainable competitive advantage. A moat, a strong brand, proprietary technology, or a dominant market share. Management matters. Assess the experience, track record, and capital allocation skills of the management team. Read investor letters and listen to earnings calls. Actionable tip. Look for companies with a history of generating free cash flow and returning capital to shareholders through dividends or share buybacks. This is often a sign of a well-managed and undervalued company. 3. Dollar cost averaging. Tailoring the frequency. Weekly versus monthly. While monthly DCA is common, weekly DCA can smooth out volatility even further. Consider market conditions. In a rapidly rising market, more frequent, weekly, DCA may result in slightly higher returns. In a volatile market, more frequent DCA can reduce risk. Automated. Set up automatic transfers from your bank account to your investment account to ensure consistency. Actionable tip. Use a DCA calculator, available online, to simulate the potential impact of different investment frequencies on your returns. Nuanced risk tolerance. It's not just high or low. Risk tolerance is not a fixed trait, but a dynamic factor influenced by age, financial goals, time horizon, and personal circumstances. 1. Age and time horizon. Younger investors with a long time horizon can typically afford to take on more risk, while older investors approaching retirement may prefer a more conservative approach. 2. Financial goals. Short-term goals, for example, buying a house in 2 years, require a lower risk approach than long-term goals. For example, retirement in 30 years. 3. Consider your comfort level. Use a risk tolerance questionnaire, easily found online, to assess your comfort level with market volatility and potential losses. 4. Actionable tip. Revisit your risk tolerance assessment at least annually, or whenever your personal circumstances change significantly. Confronting behavioral biases. The hidden enemies of rational investing. Even with the best strategies, behavioral biases can sabotage your investment decisions. 1. Anchoring bias. As we've discussed, fixating on a stock's past high price can lead to poor decisions. 1. Solution. Focus on the company's current fundamentals and future prospects. 2. Confirmation bias. Seeking out information that confirms your existing beliefs and ignoring contradictory evidence. 2. Solution. Actively seek out opposing viewpoints and challenge your own assumptions. 3. Loss aversion. Feeling the pain of a loss more strongly than the pleasure of an equivalent gain, leading to impulsive decisions. 3. Solution. Develop a long-term investment plan and stick to it, even during periods of market volatility. 4. Actionable tip. Keep a journal of your investment decisions, noting the reasons behind them. 4. Review your journal regularly to identify any recurring biases that may be influencing your choices. Economic context matters. Connecting the dots. Macroeconomic trends can significantly impact different asset classes and sectors. 1. Interest rates. Rising interest rates can negatively impact bond prices and interest rate sensitive sectors like real estate. 2. Inflation. High inflation can erode purchasing power and negatively impact consumer discretionary stocks. 3. Economic growth. Strong economic growth typically benefits cyclical sectors, like industrials and materials. 4. Actionable tip. Subscribe to reputable economic newsletters and follow economic releases from government agencies and central banks. 4. Consider how these trends may impact your portfolio and adjust your asset allocation accordingly. Portfolio rebalancing. Staying on track. Regular portfolio rebalancing is essential to maintain your desired asset allocation and risk profile. 1. Set target allocations. Determine your desired allocation to different asset classes. For example, stocks, bonds, real estate. 2. Rebalance frequency. Rebalance at regular intervals, for example, quarterly, annually, or when asset allocations deviate by a certain percentage, for example, 5%. 3. Tax implications. Be aware of the tax implications of rebalancing, as selling assets may trigger capital gains taxes. 3. Consider using tax-advantaged accounts. For example, 401k, IRA, to minimize taxes. 4. Actionable tip. Use a portfolio rebalancing calculator, available online, to help you determine the optimal rebalancing strategy for your portfolio. Investing with a purpose. aligning your strategy with your goals. Ultimately, successful investing is about aligning your strategy with your long-term financial goals. 1. Define your goals. What are your financial goals? 1. For example, retirement, education, homeownership, early retirement. 2. Time horizon and asset allocation. Longer time horizons allow for a more aggressive asset allocation. Higher percentage of stocks. 2. Shorter time horizons require a more conservative allocation. Higher percentage of bonds. 3. Regularly review and adjust. Revisit your goals and investment strategy at least annually, or whenever your personal circumstances change. By moving beyond simplistic advice and embracing a more nuanced and personalized approach, you can build a resilient portfolio that helps you achieve your financial goals and navigate the complexities of the market with confidence. The overall market can change and shift, making each scenario different from each other. Section 5. From Theory to Action. Your practical guide to empowered investing. We've journeyed through the principles of sound investing, debunking myths and uncovering strategies for long-term success. Now, it's time to turn knowledge into action. We're going beyond general encouragement and providing you with concrete steps to take control of your financial future. Revisiting the key lessons. 1. The buying the dip myth. Caution, not avoidance. Remember, buying the dip isn't inherently bad. 1. It's the blind buying that is risky. 2. Knowledge is your shield. Continuous learning is a habit. Investing is a dynamic process, not a one-time event. 3. Personalization is paramount. Tailor your strategy to your life. Your investment plan should reflect your goals, risk tolerance, and time horizon, not some generic formula. 4. Recognize your blind spots. Mitigate behavioral biases proactively. We all have biases. 4. The key is to identify them and implement safeguards. Your action plan, specific steps for immediate implementation. We recognize that diving into the world of investing can be daunting, so we're providing you with specific tools and guidance to make the process more manageable. 1. Demystifying self-assessment. Using frameworks for clarity. Goal setting worksheet. Download a free goal setting worksheet from reputable financial websites. For example, Vanguard, Fidelity, to clearly define your financial objectives. Retirement, education, down payment, etc. Risk tolerance questionnaire. Use a validated risk tolerance questionnaire. Search risk tolerance questionnaire online to assess your comfort level with market volatility and potential losses. Be honest with yourself. 2. Creating a written investment plan. A simple template. Download and adapt a basic investment plan template. Clearly articulate your financial goals. For example, retire at age 65 with $X in savings. Define your asset allocation strategy. For example, 70% stocks, 30% bonds. Outline your risk management techniques. For example, diversification, stop-loss orders. Document your rebalancing guidelines. For example, rebalance annually, or when asset allocations deviate by 5%. 3. Breaking it down. Start small, stay consistent. Small steps. Begin by investing a small, manageable amount each month. Even $50 or $100 can make a difference over time. Automate the process to ensure consistency. 4. Seeking professional guidance, knowing when it's time. Criteria for seeking help. Consider consulting a financial advisor if you have complex financial needs. For example, significant assets, business ownership, estate planning. You lack the time or expertise to manage your investments effectively. You feel overwhelmed or stressed by financial decisions. Finding a qualified advisor. Look for advisors who are certified financial planners, CFPs, or hold similar professional designations. Ask about fees. Understand how the advisor is compensated. For example, fee only, commission based, and ensure that their fees are transparent and reasonable. Staying ahead of the curve. Resources for continuous learning. 1. Reputable financial websites. Utilize free resources from Vanguard, Fidelity, Schwab, and other reputable financial institutions. 2. Books and podcasts. Explore books and podcasts on personal finance, investing, and behavioral economics. 3. Industry newsletters. Subscribe to reputable financial newsletters for up-to-date market analysis and investment insights. Addressing common challenges. You're not alone. 1. Emotional decision making. Combat this with a well-defined investment plan and a commitment to sticking to it, even during turbulent times. 2. Market volatility. Embrace volatility as an opportunity to buy undervalued assets, but only if they align with your long-term strategy. 3. Information overload. Filter out the noise and focus on credible sources of information. 3. Remember, less is often more. Taking the leap, your journey starts now. Investing isn't a spectator sport. It requires active participation, continuous learning, and a willingness to adapt. Don't let fear or uncertainty paralyze you. Take that first step, develop your plan, and embark on your journey to a more secure and fulfilling financial future. This information is to empower and educate people, and to secure a brighter economic status.